So it wasn't so much that the market was going crazy, because that's the first thought everyone's going to have. Like, okay, you sold when it actually, the fundamentals told you to sell, and then the market was just irrational. But you're saying actually these businesses had fundamentals that just kept getting better.
It just kept getting better and better, right? Because the value proposition that they were offering to their customers was improving every year by a lot, which contributed to their moat, which contributed ultimately to their earning power.
Mm-hmm.
And by looking at the business in the short term based on an arbitrary value at that moment, told you nothing, about the future of that business. And investing is really about the future. It's not about the past. And I realized the biggest mistakes I was making was extrapolating the past onto the future. And that the most successful investors are able to think in terms of the future, not the past. And as you know, it's really hard to go back and buy something for 100% more than you sold it for. It's very hard to do. And the gap would just get wider and wider and wider. And I also found myself in circles of people and around other people that, because when I got into the business, I didn't come from Wall Street. I didn't come from finance. So I didn't have any friends or any any coworkers or whatever. I didn't have any colleagues in finance to like share ideas with, and of which looking back was an advantage. And then I built this group of people that were giving me this positive feedback loop, like, oh yeah, you're doing the right thing. Yeah, that's being disciplined. And I'm like, wait, but the company just grew earnings by 30% and 40%. And then as time
you
went
were
on,
selling, they were telling you sellings.
Yeah, well, just in that typical kind of, price-oriented, rear-view looking value community that, just started, it was this positive feed. Everybody's feeding off each other. But my investors were like, well, why would you sell that? When I'd write a letter about something, or mention a stock that I had sold, and they'd be like, wait, why did you sell that? Well, because I have this great new group of friends that really encouraged me to do the right thing and sell at intrinsic value. And that was a margin of safety. And I thought, oh, you know what? And then as the years went on, I noticed that it really took, in order to be a great investor, you really have to think independently. And these are things that Buffett teaches us. Buffett doesn't teach us to lock arms with a group of 10,000 like-minded people, all oddballs, and all do exactly the same thing, and all not evolve unless one does. And then when one does, then you can evolve. I mean, that's not what Buffett teaches us. So he also doesn't teach us to buy low-quality businesses. He teaches us to think about a stock like you're buying the whole business, and that's up to you to interpret what that is. But if you were to buy a business, you would do a lot more. It wouldn't just only be based on price, right? You would actually do research on the business and think about what are the future prospects of this business, and that would be the focus. And you wouldn't sell it unless there was a material reason to sell it, like a business reason to sell it. Somebody could offer you more than you paid, and maybe that's your goal. But if you were a long-term investor trying to compound money at a tax-free rate because you're not paying taxes until you sell, which is an American fund, that's our challenge. Then you would want to own companies that could just keep compounding. So that led to a decision to overhaul the whole way that I was thinking about businesses, and just kind of not start over, but really analyze the mistakes that I made. And the mistakes were mistakes of omission, but really big ones. I mean, I'm not talking about, we could have made another double or triple. The mistakes were all more than 10 baggers. I mean, one was actually
10x.
One was actually 100-bagger. I'd be managing I'd be managing some astronomical amount of money by now if I had just sort of bought and held some of the first businesses. And what they all had in common was that they were run by normally founder-led CEOs, and they were investing 100% of their gross margin back into the business at incrementally higher rates of return. And they were making their business more compatible for tomorrow's economy than yesterday's economy. So they weren't necessarily tech companies, but they were companies that were thinking about the future of their business, even if it was a basic metal stamping business. They just, they recognized that it was no longer 1946 and that they needed to move forward. And most businesses are not set up to do that. Most businesses are set up to just pay a dividend or just think about the past and just kind of maintain, and not get up every day and fight and refight and start all over again and earn it and try to stay number one in their industry
and innovate, change, move with what's happening in our very fast changing world.
Absolutely. So I developed 4 principles. I looked at, and
you developed these principles to determine how to find companies that would be able to do better in the future.
Yeah, my business partner and started as my analyst, Seth. We looked at, I don't need to go down to a tangent, but we looked at,
I love tangents. Give me the tangents.
We put a study together called Peak to Peak, and we looked at companies over major cycles going back to the 1940s or 50s or so, and the mid 1940s. And we assumed that you bought the companies. We assumed that you bought all companies at the peak, and then we wanted to see how all those companies did if you held till the next peak. So you had no advantage of ever getting a deal, essentially.
The peak being the peak of the market?
The peak of the market. Okay. The peak of the market. So let's call it peak.com. Let's call it peak 2007, before the financial crisis. Let's call it peak 1960s.
How far back did you go?
50s. We went back to the kind of the mid 40s, which didn't produce a big peak, and a lot of those companies are not publicly traded or we couldn't find data for a lot of them that were. But in order to qualify, you had to be continuously publicly traded, and you had to be over the equivalent of 500 million in market cap at the beginning. So very investable companies. So we weren't looking at the micro caps or whatever. And we also excluded biotech because it just wasn't something I just thought I want to sort of see the way the universe shakes out with more traditional businesses, including tech, but just non-biotech.
And did you say companies that were there in 1940-ish something and are no longer publicly traded now?
They had to be,
in order to qualify,
they had to be visible and publicly traded continuously through to the next major peak.
Okay, got it.
So it was kind of.
I was going to say that's not going to be very many companies.
So we wanted to see what the characteristics were of companies that you bought, because everybody before this crisis, this COVID crisis, all people talked about was it was this long, market highs and when is it going to end, and it's going to come crashing down, and it's peak, and it's peak. Every day was peak, new valuations, longest run long run, and we wanted to kind of, and this has been going on for obviously since 2007. It's been basically just going up. And a lot of it you could say is maybe it's, macro, there's some, interest rates and stuff at play. But going back further than that, we wanted to see look, if you bought everything at the peak and you held to the next peak, who outperformed the market the widest and why? And who underperformed the market the most and why? And who never came back and who did? So it's fascinating what we found. The top 25%, at least let's take, for example, the financial crisis, 2007. And I don't remember the numbers off the top of my head now, but the top 25%, were double or triple the S&P 500 at the time. And we did a 12-year peak to peak, and now probably need to be updated again. So we ended it. The peak was, I think, October 7th, 2007 or October 10th, 2007 or something like that. And we did it through until 2019, October 2019. But the companies that, really did well, the companies that were, 5x or more than the market, weren't the companies you would think they were. They weren't just, it wasn't just, Netflix was the number one, but it wasn't like this list of tech companies below it. It was actually a list of companies that you would think of as relatively normal, like Domino's Pizza, for example, was in there.
That's a good one.
And these are companies that made, 1,300, 1,500% returns, multitudes better than the S&P if you bought them at the absolute peak of the market and held them. So if you had any advantage of time in addition to that, the returns would have just been unbelievable.
You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.